Novo Nordisk Stock is down 58% from its all-time high, so let's see if this is a good opportunity to buy the company by looking at the fundamentals and running a DCF model to estimate the intrinsic value of the company and potential future returns. This massive drop in price is due to multiple reasons. The latest being that its two big Alzheimer's studies failed to show that they slow Alzheimer's decline versus a placebo. Moreover, competition has increased, especially in the US with Eli Lilly, which has led to a change in CEO and guidance cuts. One of their drugs also disappointed, showing less weight loss than expected. The stock also fell because in the US, some people get cheaper copycat compounded versions of Novo's drugs instead of the real ones. But if we zoom out, NVO's revenue has grown from 107 billion Danish crowns to 315 in the past decade, which is 48 billion USD and a compounded annual growth rate of 11%. Their biggest revenue segment is diabetes, where they have seen solid revenue growth, but where they have seen very high revenue growth lately is in their obesity segment. And analysts are expecting revenue growth to continue, as they are expecting revenue to grow between 5 and 9% over the next 5 years. Regarding profit, their net income has grown from 34 billion Danish crowns to 103, which corresponds to 16 billion USD. A negative aspect is that they have significantly less free cash flow. Analysts are expecting little profit growth as they have EPS growing at single-digit numbers over the next 5 years. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my spreadsheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. The intrinsic value according to my low assumptions is $33 per share, middle $55, and high $80. And because the stock is currently trading at $49, this means that if my low assumptions occur, you would get a 4.5% annual return on your money, middle 12.9%, and high 19.9%. Now, as far as my assumptions, I assume they grow revenue between 5 and 9% annually for the next 7 years, the average of profit margin and free cash flow margin between 20 and 30%, because even though they've taken a big hit, and with competition, I think it's going to be hard to get back to that 30% they were doing. And I also assigned a PM price to free cash flow at the end of the 7 years of 15, 17, and 19. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. By the way, these returns include the dividend, which currently has a 2.5% yield. Moreover, they are currently trading at a P of 13 and price to free cash flow of 20, which in my opinion makes the stock fairly valued or slightly undervalued. Lastly, they have an okay balance sheet with $5 billion in cash and 15 in debt, which is manageable for a company with a market cap of $206 billion. And in conclusion, I believe that NVO is a very hard company to value at the moment because it's hard to predict what revenue and profit are going to be in the future, which is why I'm going to pass for now. However, if you believe strongly in their products and future, this might be a good opportunity to buy the company at a discount. Lastly, if you want a discount on stockanalysis.com, grab my code in the description. I hope you found this video valuable. Let me know what you think about NVO stock in the comments, and I'll see you in the next one.